Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, how are we going? We are back again.
Andrew, we are back again and ready to rip into another episode, which I am sure will enthrall our listeners and our viewers because this is something that everybody loves.
Not everyone.
Or hates, depending on which way you look at it. But yes, you're right, actually. Not
ATO
everyone
doesn't like this topic.
This is true. And the topic that we're talking about is how do we minimize our tax?
Legally.
Well done, Andrew. Well said, well summarized. Let's rip straight into it.
Yeah, I mean, look, I kind of have I have a bit of a gripe with this question. I don't have a gripe with the question. I just don't think that the question for 99% of people is actually the question. Most people say, I'm paying too much tax. I'm on a high income bracket. How do I minimize my tax and grow my wealth? And my usual response to that is, you can never not pay tax and grow your wealth. And so you're always going to, anytime that you make a profit, whether it's an income, whether it's a capital growth, whatever it is, you're going to pay an element of tax. So what the question really is how do I continue to pay tax but do it in the most efficient way while still growing my wealth? Because reducing your tax bill means that you're making a loss somewhere. And so ultimately what you're really trying to do is not reduce your tax, but actually just be more efficient or make sure that I'm maximizing the method of how I'm growing my wealth while still keeping the tax to a minimum. So it may not mean that you're paying less tax. What it actually might mean is that you're paying more tax, but you're also accumulating a greater income. You're doing more with your money, which is resulting in, your overall or your percentage tax going down.
Yeah, and I might just add a little bit to that, Andrew. And I think the reason why we come across this, and there's absolutely nothing that we can do about this, but the reason why we come across this question so often is because in Australia, the taxation system is ridiculously complicated and it's fairly onerous. Like if you look at the amount of tax that we're paying, you just talk about the personal income tax rates as an example and you work your way through and there's tax reform going through on the bits and pieces, but then you get taxed on your income as an example, and then you go and spend money on a cup of coffee or whatever it is that you buy and you're paying GST. So then you're paying more tax there. And then you take the money that you've made from work and you go and invest it in the stock market or in property and you're paying tax there once you make a gain on either the capital gain or the income that's derived off that asset or whatever it may be.
When you first purchase
stamp duty, fuel excise, you name it. So I think the reason why this comes up so often is because, one, the system is too complicated and that's just the way that it is. But ultimately, we're being taxed too much. And that's happened even recently as well too, where we've seen things like the short-term holiday rentals incurring a 7.5% levy, which is just a fancy word for a tax, to try and support or discourage people who have holiday rentals from renting them out on things like short stay, Airbnb type of websites, stays.com and the like, and transferring those from short stay holiday rentals and making them available in the traditional sense to people who want to rent properties to live in for the longer term. But we're taxed too much.
Ultimately, it's just
and that's
paying enough tax.
And that's the reason why we get this question come up so often. But one of the things that I think is really prudent and kind of ties into what you were saying is, what are the mechanisms that we can use in order to try and grow our wealth while still managing or paying the minimum amount of tax that we possibly can from a legal perspective? And I think something that we pivot into a fair bit of is superannuation. Andrew, tell us, what does that look like in terms of, how can we minimize our tax through super?
Yeah, I mean, look, superannuation for us is, at least from a tax perspective, is one of the greatest assets that you can ultimately hold for a variety of different reasons. One, by putting money into superannuation in concessional or pre-tax contributions, you have the ability to claim a tax deduction on effectively giving money to your future self. So you put money into superannuation. Let's say your employer's, making the regular superannuation contributions on your behalf, and you decide, I'm either going to salary sacrifice or put in a personal pre-tax contribution towards superannuation. And let's say that's $10,000. And you're on the highest marginal tax bracket, so you're paying 47% tax on your income. You'll actually get, on that $10,000 that you put into superannuation, a deduction of $4,700 by purely just putting money into superannuation. So you're saving tax purely on contributions. Now, bearing in mind, and this is something that sometimes people can forget, is that a pre-tax contribution gets taxed on the way into superannuation. So you'll pay 15% tax. So you're not actually saving the 47%, you're saving the 47 less 15, you're saving 32% tax. So from a contribution side of things, there's a tax deduction. But then in addition to that, let's say that money is invested and it incurs either a capital gain or it incurs an income. And all of a sudden, not only are you getting a tax deduction on the amount that you've contributed to super, but the profits that are associated with it are taxed at superannuation rates, which are at 15% flatline. So it doesn't, for most people, the 15% tax on profits that they make with investments is lower than any other environment that you're ultimately in. And so there's a tax benefit with the earnings. And then let's say you turn 60 and are no longer working, or you're over the age of 65, regardless of what your work status is. Well, now all of a sudden you've also got access to an asset up to, I think it's $1.7 million is where the transfer balance cap is now. 1.9, wow. Indexed a few times. We've got $1.9 million available that's tax-free, 0% tax environment. You make a capital gain in that environment, you make an income tax in that environment, all of a sudden you're paying no tax whatsoever. So from a long-term planning perspective, it is...
Yeah, it's the best environment that we can get. Calling out the trade-off associated with that though, because using superannuation, the money is preserved until a future point in time, age 60 and retired, age 65 regardless of your work status, or there's some other things around that where you can access the superannuation or your superannuation if you need to, but that's definitely the trade-off. And that's one that we pivot into a lot of. And also above and beyond that, if you haven't, in certain circumstances, if you haven't taken advantage of your cap in previous years, you can actually go back to previous years and bring those caps or utilize those caps that you haven't used. So there is an opportunity to be able to try and get a large amount of money into superannuation in a real tax effective way from that perspective as well. But once again, calling out that trade-off that you are tying that money up. So getting the balancing act right, but when the circumstances are right, being those ages and those thresholds that we were talking about before, you can't beat it because everything as it currently stands is tax-free up until a balance transfer cap.
Yeah, it's a fantastic environment from a tax perspective, but it just definitely needs some long-term planning. And for a lot of people, especially when we're talking to clients that are younger, what ultimately the conclusion they're coming to is, yes, great, let's utilize some of the tax benefits of that, but I still need some assets that I'm going to need access to earlier than meeting my retirement age, because one, for the purpose of flexibility, or two, some people have a goal of retiring at the age of 50. So if all of your money's tied up in super, you don't actually have access to it until you turn 60 years old. And so as a result, you need an asset that's going to provide income between that period of time. So hence why we need to not only look at superannuation as an investment vehicle, but also look at alternative means for, tax effective investment as well.
Good conduit, Andrew. And we were talking about the share market in last week's podcast and last week's episode. Talk to us about franking credits and how they tie into, I guess, a tax effective investment strategy.
Yeah, I mean, look, franking credits, just to sort of maybe say it in its most simplest form, is let's assume that a company is paying... Sorry, I'm going to take a step back and just look at the income that's associated with an investment. If you have an investment and that investment derives an income for you, that income goes on top of your taxable income, and you will pay tax at your marginal rate of tax. So let's say you're at a 37% tax bracket. You derive an income from an investment like a share, let's say, and that income is $10,000 over the course of the financial year. Well, that $10,000 is going to go on top of your income, and you're going to pay your 37% tax associated with it. What franking credits are recognizing that, and this doesn't apply to all companies, so you do need to be specific around which shares you're investing in, but if a company, let's say the corporate tax rate is at 30%, the company has already paid 30% tax on their profits. They distribute that $10,000 to the shareholders. Mm-hmm. The shareholders will pay tax at their marginal rates. And so without franking credits, essentially that $10,000 is taxed twice. It's taxed $30,000 in the hands of the company, and then $3,000. It's taxed $3,000 in the hands of the company, and then $3,700 in the hands of the investor as well, or the owner, the shareholder. So what franking credits is basically getting a tax offset for the $3,000 tax that the company has already paid. So the company has already paid the $3,000 tax. You minus that off the underlying tax that the investor will pay, and so the investor's not necessarily paying the $3,700 tax, but only $700 in tax because they're getting an offset in the form of franking credits.
Yep. No, absolutely.
So another means to be able to invest in a particular asset and still derive an income but pay a lower amount of tax, because franking credits are obviously not available for every investment. You don't get any of those benefits when you're talking about investing in, let's say, an infrastructure investment or a property investment or something that's deriving an income. So positioning your assets for franking credits can be another means to help invest in a tax effective manner.
Yeah, no, well said. I think the one that is probably the most well known in Australia, at least, is negative gearing. So this is the common, hey, Mr. or Mrs. Accountant, I'm paying too much tax. What do? Go and buy a property.
Yeah, negative gear.
Sign on the dotted line, negative gear. So what does that look like? You essentially go and buy a property, and the theory behind it is that what the income that's coming into the property, and I might just use some numbers here. Let's assume that your income that you're deriving from the property is $400 a week, $20,000 a year. So $20,000 is your income that you're receiving off that investment. Let's just say your outgoings, which predominantly most of that would be repayments of your loan. Let's just say your outgoings are $25,000 a year. Your cash flow, you're down negative $5,000 per year. Now, in its simplest form, the negative gearing is the difference between the money that you've got coming in and the money that you've got going out. Now, I won't get into too many details around that, around what's deductible and what's not, but in a real simplest form, you're in a cash flow negative position, which is where the term negative gearing comes from. So from that investment, as an example, $5,000 a year, you're out of pocket, negatively geared, $100 a week, $5,000 a year. When you do your tax return, you've made a $5,000 loss, which you can then claim back as your tax deduction in your tax return. Now, the reason why this has been a popular strategy is because each and every year, even though you're out of pocket, you get to claim it as a tax deduction. So on paper, you're paying less tax. But then over time, with the capital growth associated with the property, you then buy the property at we'll use $500,000 as the number, and then down the track you sell it for $1 million. You've made a $500,000 capital gain. So people and the taxation system supports this in Australia, but you can purchase a property that is helping you from a taxation perspective each and every year, and then you make your benefit and you make the real money, I guess, so to speak, with the capital gain when you sell it at the end of, whenever you decide to sell it.
Yeah. And look, the caveat that I'll put on that is, one, obviously it needs to meet your cash flow requirements. You have to have the cash flow in order to be able to support it. You have to have the risk tolerance in order to be able to support it. But specifically negatively gearing a property is a terrible idea. So if you can rent the property out for a higher value, yes, you might pay more tax, but in that same scenario, you'd rather make $5,000 and pay whatever tax that you're going to pay on it, and you're still left with money, than lose $5,000 and get a portion of that $5,000 back. So what this strategy entails is not intentionally losing money, but selecting a property that won't necessarily give you a high amount of rental income, but is expected to give you a higher amount of capital growth. That's what you're trying to do. You're not trying to specifically decrease your rent to claim a tax deduction. I've seen that once or twice before.
It has happened though, but you're right. From an investing perspective, it actually makes no sense to enter into an investment where you're going to lose money, regardless of whether you're going to make it up in the long term. Yeah. But it just goes against investing principles.
Yeah, exactly right. So you need to ultimately have the cash flow, the tolerance to risk, the long-term strategy, and be able to, because there is a real skill involved in this, and maybe you can get some support from a professional, but select a property that you know with a certain degree of certainty is going to increase in capital growth in future years.
Yeah. Andrew, I think a really big one that we need to touch on is the tax-free exemption associated with your owner-occupier. So with an owner-occupier...
Tax exemption on your owner-occupier property?
Well, I don't know if I've actually got that right, but you don't pay any tax on your owner-occupier,
Oh, sorry.
right?
I thought you were going into a different... Sorry, I was setting us up for the next point. That's my mistake.
Which it will lead into the next point, because Andrew is itching to talk about debt recycling. So I thought I'd introduce the owner-occupier first. But in Australia, on your primary residence, your owner-occupier, your principal place of residence, if you make a capital gain, you do not pay tax on the capital gain, as the law currently stands in Australia. So as an example, if you bought a property today for $1 million and you sold it in 10 years' time and you sold it for $2 million, pound for pound, you've made $1 million capital gain. In any other or almost any other transaction with any other asset, that $1 million would be subject to capital gains tax. Whereas if it's your primary residence, it is not. So that's the other thing that we see in Australia, I guess, that helps support the property market, is that there is incentive for homeowners not to just use a property as shelter, but to spend time, to spend effort, to spend energy, to spend money on doing the property up, improving it, renovating it, maintaining it. So then eventually when it does get sold, there is no tax. So it's a really good vehicle. And if you're a builder or a tradie and you've got some skill, there's actually a bit of skill in this, and you need to make sure that you're on the right side of the law with this, because you can't do it intentionally to try and make money without paying tax. But that's a really good way for, I guess, your homeowners to be able to make money, is by the value of their property going up and not paying tax on it.
Yeah, and eventually, I've seen it happen before where people will do some renovations and increase the value of their property, sell the property, and then use that to purchase another owner-occupied property and potentially snowball that and have an amount of money that sits on the side that necessarily haven't had to pay any tax on, despite making a profit on. So it's definitely a strategy that's worthwhile.
That's it. And Andrew, I know that you've been itching to talk about debt recycling. So Andrew, run us in. I know that we've done a couple of episodes on the podcast about debt recycling. Really worthwhile strategy. Rip into it. Let's go.
Look, essentially what a debt recycling strategy is converting the debt that's associated with your owner-occupier. Now, an owner-occupied property, if there's a mortgage associated with it, the interest that you, or even the repairs, the maintenance, but the interest component of your property is not tax deductible because it's not used for an investment purpose. I'm not going to go into the details of it because it's an entire podcast and really requires some in-depth analysis when you talk about it.
So go back and listen to the previous episodes.
Go back and listen to the previous episodes. But a debt recycling strategy is a strategy whereby you pull equity out of an owner-occupied property, you utilize that for an investment purpose. The income associated with that investment pays down not the debt that you took out on the original property, but the owner-occupied debt. And essentially, over the course of a number of years, you convert your owner-occupied debt. You continue living in the property, you don't move out, nothing changes in your circumstances, but you can convert your owner-occupied debt to tax deductible. Love it.
What a strategy, Andrew. What a strategy.
Look, it's something that, again, you need to, pass the sleep test because you're taking on additional debt, you're utilizing it for investment, and you're taking it against your owner-occupied property. So there's obviously a few things that you need to consider, that you're doing it in a measured approach, that you're investing in good quality assets, you're getting advice, you're doing it in the right structure, all of that stuff. But it's a very worthwhile strategy considering for many people if there is equity associated with your owner-occupied property, because the tax system essentially allows you to convert your debt from non-deductible to deductible, which is massive if you consider the deductions that can be associated with that after you've deployed this strategy for a little while.
Yep. Andrew, different asset ownerships. Obviously, there's different opportunities that we talk to clients about. As an example, if you've got, in a really simplistic sense, if you've got two members of a household, so two spouses, and you've got the ability to distribute income into the name of the lower income earner, essentially what you're doing is you're working your way through the tax brackets, so you're paying less tax along the way. So that's a really worthwhile and simple strategy if you're in that position. Normally in that instance, you need to either do one of two things. You either need to be a business owner that allows you to direct profit to a particular individual, or you need to get the asset ownership structure correct when you first enter into that particular investment.
Yeah. So whether that's investing through a trust, which has its own implications and need to consider, whether it's just purchasing it in a particular person's name, definitely getting the ownership structure right at the start is the key to this, because if you've already got the asset, there's potentially capital gains or stamp duty implications of needing to change direction in the future.
Yeah, it becomes very complicated and very expensive if you need to do that. And a lot of the time, the cost associated and the headache and the time does not justify doing it necessarily, unless we're talking significant amounts of money. But around that would be, a mathematical calculation around how much it would cost. You'd need a professional to be able to calculate that for you. But that's definitely another thing that we look at. From a really simplistic perspective, when you're doing your tax return, getting advice from your accountant about what deductions or what things that you can claim as deductions to try and help you get a tax refund back if possible.
And potentially even bring forward, if you are a business owner, you can utilize the instant asset write-off, bring forward the purchase of an asset in a particular year where your taxable income is highest. So let's say you've made a capital gain, if you can bring forward that, expense in order to maximize the tax deduction, that's also another, really key element to minimizing your tax. The one sort of caveat that I'll put in all of this is also consider and make sure that you're engaging it. And this is why we're really big advocates for having a team of people around you. I mean, realistically, you need an advisor, you need an accountant, you need a mortgage broker that are all working together, because an advisor and an accountant's job are sometimes in contrast with each other, because an advisor is all about wealth maximization, an accountant is all about tax minimization. But then you also throw into the mix, okay, what about the underlying borrowing capacity? So we've seen instances where a client has gone down a particular strategy on minimizing their tax as much as possible. They've done really well with it. So they paid very little tax because their income was extremely low. But then they also had a goal of purchasing a property in the subsequent financial year. And all of a sudden, the bank's looking at their tax return and saying, hey, you made a loss this year. I'm not lending you any money because you haven't actually made any money. So making sure that all of the professionals around you are speaking to each other, understand what you're wanting to achieve, understand what your future plans are, is a really important part to this, because you might do the tax minimization strategy so well that it throws off all of the other stuff that you're wanting to achieve as well.
Yeah, no, well said. And probably the last thing that we talk about, and we have been speaking about this recently, is certain investment products that are tax effective. So we've spoken recently about investment bonds.
Yeah.
So an investment bond is a tax effective strategy. This is a fairly specific type of investment. There are some limitations and some parameters around that, but essentially what it does is, in this instance, it caps the tax rate at no greater than 30%.
Yeah.
So if you are a high income earner and you've maybe expunged or exhausted some of those other options that we were talking about, this could potentially be a consideration as well too, because if you're being taxed at 30% versus your marginal tax rate of 47%, if you're on the highest bracket, then there's a significant differential in terms of the tax rate associated with those two options.
Yeah, absolutely. Bills, I think that summarizes some of the considerations that some people should be making around, how do they minimize their tax, still grow their wealth all at the same time. So hopefully to all of our listeners and all of our viewers, that's answered some of the questions that are associated with that as well. And thanks again for another podcast, Bills.
Andrew, no worries. And to our listeners and our viewers, thanks once again. Like and subscribe, and we'll catch you on the next one.
Thank you.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.